Hi and welcome to the Lending Front. My name's Spencer and today we're going to be talking about unsecured loans. So what is an unsecured loan? The best way to go about this is to first describe what a secured loan is. The best example being a mortgage. In this case, you take out a loan and you secure it against a property. Now if you miss any payments for that loan, the lender has a legal right to repossess the property. An unsecured loan isn't like this. There's not a specific personal asset that the loan will be secured against. So you're probably asking yourself, where's the liability? With most unsecured loans, lenders will make you sign a personal guarantee. A personal guarantee is a legal promise to pay. Now this does make you personally liable for the finance, but you are not solely responsible for the finance when you take it out. The company still holds the main responsibility to pay the funds back. So if, for example, the company is struggling to make the repayments, the lender will try and work with your company to make those payments either smaller or reduce the frequency of those payments. Most unsecured lenders, when they charge for these short-term unsecured loans, is they use a factor rate. Now this is a decimal, and the way that you work out your repayment is you take the amount you're borrowing and you times it by this factor rate to give you your total repayment amount. Example being, if you were to borrow £10,000 at a factor rate of 1.2, you'd be paying back £12,000. Now, the terms of these loans vary. They can go from anywhere from 3 months up to 5 years. Now, to work out how much you'll be paying on a monthly basis, you take your total repayment amount and you divide it by your term in months. To apply for an unsecured loan is very simple. All you need to do is approach the lender via telephone or their website. All they'll require from you is minimal documentation, normally being bank statements, VAT returns or end of year financials. You will also need to fill out an application form. This more than likely will be online as well. Now we're going to look at some pros to do with unsecured loans. The first being is that they're very fast. From application to approval, it normally only takes a day or two. Secondly, only minimal documentation is required. All you need to send over is bank statements, VAT returns or end of year financials. Unsecured loans are also very flexible. This is down to the fact that they are short term. You're not locked in for 27 years as though with a mortgage. Now we're going to talk about the cons to do with unsecured loans. The primary one being it's going to be expensive. Due to the fact that it's not secured, the lender doesn't have an asset in which they can recoup if you do not pay the loan back. Secondly, the loans are based on creditworthiness. Now what this is based on your credit score. Your credit score is basically your past pay history, meaning if you have a bad credit score, it means you're a bad payer beforehand. The reason creditworthiness is a con is because you might have been a bad payer in the past, but that doesn't mean you're a bad payer now. It seems unfortunate that most of the lenders in the market put so much emphasis on this. So to summarise, an unsecured loan is a loan that's not secured against any assets. It's short term and it will be expensive. All that is required is minimal documentation to apply, and you will have to sign a personal guarantee, which will make you personally liable for the finance. Thank you for watching. I hope that was helpful. For any more information, please click the link below. It'll take you to the Lending Front website, which is filled with useful guides on unsecured finance.